Mr. Abdullah?
Yes, sir. We can start now. I think I'm not taking much time of you. I'm just welcoming all of you. A warm welcome to another fruitful session of Mr. Advocate Vinay Shraff. Sorry, my kid is also here. She is shouting. Sorry for that. So over to you, sir. You can take it.
Yeah, good morning, everyone. I think the participation is low today because of the Christmas day, and I don't know, today is holiday. But nevertheless, I think we should commence and a warm welcome to all the participants and Merry Christmas to all of you. My endeavor in this series of webinar is to bring to the fore the wisdom which is hidden in the jurisprudence, which has been decided in the erstwhile regime, that is indirect tax regime, that is of central excise, service tax, VAT, central sales tax, and other indirect taxes. Most of the concepts, as we know, in the GST era has been imported from the erstwhile era, and therefore it is extremely thank you, Arup, for your words of encouragement. So I'm here to discuss with you the judgments and the jurisprudence which is already decided, and I think which is going to help us in dealing with the issues which are going to arise in the coming future. Already I was reading just a few days back that more than 5,000 notices have been issued, and many more must be in the progress of being issued. So therefore, in the coming 1 or 2 years, I believe that a lot of litigation is going to arise, and we need to arm ourselves with the knowledge which is already there in the erstwhile era, so that we can handle those issues. Today, I am going to talk about some of the fundamental concepts and some of the issues which are going to arise in the context of the definition of the supply. So, Mr. Abdullah, can you allow me to share the screen so that I can share the PPT?
Yes, sir. Please take now.
So is it visible now?
Yes, sir. Very much.
Okay. So the first thing which I would like to discuss is the meaning of the term goods. You see, the goods and service tax is applicable to goods or services. So first and foremost, we should know and try to decipher the meaning of the term goods. The term goods is defined in section 2, subsection 52, which says that it means every kind of movable property other than money and securities, but includes actionable claims, growing crops, grass, and things attached to and forming part of the land, which are agreed to be severed before supply or under a contract of supply. So, in order to be goods, first of all, it must be movable. An immovable property is not part of the GST goods and service tax at all. Now, immediately the question may arise in your mind, then why this immovable property in the form of flats or commercial properties are being taxed? So there, in case of an immovable property, it is deemed to be a service, provided that one enters into a contract with the prospective buyer before the completion certificate has been issued. So if the consideration is received prior to the completion certificate and the contract is entered into prior to the completion certificate, only then it becomes a part of the goods and service tax regime, because then it is considered to be a service rendered by the developer for the prospective customer. So therefore, it is covered within the goods and service tax regime. But if it is a completed property, so if anybody enters into a contract for purchase of a property which is already in a completed stage, then it is a contract for immovable property, and therefore it is not covered within the purview of goods and service tax. Now, immediately, as we see in the definition, it says that the growing crops, grass, or things attached to or forming part of the land which are agreed to be shared before supply or under contract of supply is covered within the definition of the goods. So there is a Supreme Court judgment on this particular issue, that standing trees are not goods and therefore not taxable. But if the standing timber is identified and the contract is unconditional and the timber is in a deliverable state, then it will be a case of immovable property and it will be goods, and therefore it can be taxed. So this particular judgment, I think, is very useful to distinguish under what circumstances the standing trees or crops or grass or things attached to earth can be taxed or cannot be taxed. Now, the next question which arises is that in the erstwhile era, one of the criteria for a goods to be movable was that it must be possible to bring the goods to the marketplace. It must be movable from one place to another, and it must be possible to bring it to the market in order to make it marketable and therefore to treat it as goods. But as we know that in the present world, the distinction between a tangible and intangible has blurred to an extent, in the manner that the intangible ones are also capable of being sold as any tangible property is being capable of being sold. So in Bharat Sanchar Nigam Limited versus Union of India, the Honorable Supreme Court laid down the condition when a property becomes good and it is capable of being treated as taxable. It was held by the Honorable Supreme Court that in order for a property to be treated as a goods, if it has attributes, that it has some utility, it is capable of being bought and sold, and capable of being transferred, delivered, stored, or possessed. So from the age-old criteria of being brought to the ability of being brought to the market, the latest criteria is that it should be capable of being transferred, delivered, stored, and possessed. So both tangible as well as intangible properties are treated as goods, provided it has attributes of utility, it is capable of being bought and sold, and it is capable of being transferred, delivered, stored, and possessed. So irrespective of whether goods are incorporeal or corporeal, tangible or intangible, they must be deliverable, and if they are so, they will be treated as goods, and therefore they will be covered within the purview of the GST also. Now, some of the examples of the intangible property having been treated as goods are that the copyright, the licenses issued under the exempt policy, that is DEPB or REP, or the licenses which are marketable and transferable, they were treated as goods. Transfer of right to use trademark was treated as goods and deemed sale. Technical drawing has been treated as goods. Master copies of films and songs have been treated as goods. So these are the examples, some of the examples of the intangible ones which have been treated as goods. Now, in the same breath, duty drawback has not been held to be goods. It has been held to be simply a case of receipt of money, and money is not covered within the definition of goods and therefore outside the purview of the taxability of the GST. Duty drawback, we know that it is a refund of the customs element of the, in case of an export of goods. So it is a direct transfer of money in the account of the exporter, and therefore it is not transferable to anybody. It is not a scrip. Unlike you see the scrip of DPB or other such licenses which are issued, which are easily transferable to another exporter or importer, duty drawback is not transferable. It is a money which is directly credited to the account of the exporter, and therefore it does not satisfy the definition of the good. Now, another question which is very important to determine as to how to distinguish a movable and immovable property. Particularly, this issue becomes very important in the context of a plant and machinery. There may be a plant and machinery which is attached to the earth and become permanent part of the, become permanent and become so attached to the earth that it takes the shape of the immovable property. But if a plant and machinery is attached to the earth, or any equipment is attached to the earth or embedded to the earth by nuts and bolts only to ensure wobble-free operation, then it does not become immovable property, and it fails the test of permanency which is required to distinguish between a movable and immovable property. And as per the test laid down in this Honorable Supreme Court judgment in the case of solid and correct engineering works, it is important that if it is attached to the earth, then the attachment should be such that it should not be capable to detach it without demolition or damage. So if it can be detached from the earth without damage or demolition, then it can be considered as a movable property. But at the same time, if a plant and machinery as it is attached to the earth in such a manner that it cannot be detached without substantial damage, then it will acquire the character of a immovable property. So this is very, very important in the context of claiming the input tax credit also, always the liability to pay GST. Because if suppose in case of a mobile tower, now the technology is such that mobile towers can be shifted from one place to another without any damage. They are just they are just attached to the earth by nuts and bolt technology. So it can be argued that such mobile towers which can be detached and transported to another place does not acquire the character of immovable property, and therefore they are eligible for input tax credit also. Similarly, these days, you know that a lot of structures, particularly warehouses, are constructed through prefabricated structures, which can be easily dismantled and which can be stored to another place without any much damage. So such structures are also movable property, movable goods, and therefore they are not considered to be immovable property. Now, another, I think, very, very important question or the area of dispute which is going to arise in the foreseeable future is the transfer of undertaking or a business. What happens if any undertaking, suppose a company has, say, 4 units or 4 branches or 4 different types of business, and one type of business is demerged and transferred as a whole, along with the plant and machinery, land, assets, and liabilities, then whether such a transfer of business, whether it, if at all, it can satisfy the definition of goods at all. If it cannot satisfy the definition of goods in the first place, then the question of levy of GST on such transfer of business cannot arise at all. So this particular question was answered by the Honorable Supreme Court in the case of Duncan Industries Limited versus State of UP, wherein it was held that if the whole of business, along with the plant and machinery embedded to earth, is transferred by conveyance, then the plant and machinery will be treated as immovable property. And the question whether a machinery which is embedded in earth can be separately taxed, even though some value is assigned to it, is a question which needs to be answered in the context of transfer of a business, and it was answered in this particular judgment, even though it was in the context of the stamp duty value, wherein you see the entire plant and the business was transferred along with the plant and machinery. And the question was whether on the plant and machinery the stamp duty can be levied or not. So it was answered that since the plant and machinery are embedded to the earth and they cannot be dismantled without substantial damage, and it is not that the plant and machinery are separately handed over, so therefore it cannot be visualized that the plant or machinery can be deducted from the value of the business for the purpose of conveyancing, for the purpose of determination of stamp and duty, and therefore the whole of business which has been transferred, it will be subjected to stamp duty. Now, this particular judgment is useful in the context of GST also, where the entire business is transferred along with the plant and machinery, and such plant and machineries are embedded to the earth, then in my view, they cannot be considered as goods in the first place, and therefore the question of liability to tax under the GST does not arise at all. Now, there is a old judgment in the context of sales tax, that wherein you see the business as a whole was transferred, and it also included the stock in trade. So the issue was whether the stock in trade, which is forming part of the whole of the business, whether it should be taxed separately, because stock in trade is obviously taxable. But it was held by the Honorable Allahabad High Court that since business is not goods, therefore the proceed of sale of business cannot be included in the turnover, even if the transfer of business, a part of it includes stock in trade. It is an accepted fact that the stock in trade is taxable and should have been included in the turnover. But since in this particular case, the stock in trade is not separately transferred, it is transferred along with the business. Therefore, the entire amount of the proceeds of the sale, it cannot be vivisected, and a part of it, which represents the stock in trade, be included in the turnover for the purpose of charging sales tax. So this is also a very useful judgment in my opinion, to deal with the issue whether the transfer of business can be taxed at all or not in the first place. In the GST, even though the transfer, it is an established jurisprudence that the transfer of business is not goods. But we know that the service of definition in the GST Act says that what is not goods is a service. So the question is still to be answered whether the entire transfer of business is a service or not. On that, there is no jurisprudence as of now saying the erstwhile error. But fortunately, in the GST, transfer of a going concern as a whole or as an independent part has been exempted by virtue of entry number 2 of the notification 12/2017. So therefore, the moot question which arises for our consideration in such cases is, what is a going concern? Transfer of business is not goods. Even if it includes stock in trade, it is not goods. Even if it includes some movable plant and machinery or immovable plant and machinery, it is not goods. But it may or may not be considered as a service. Now, even if it is considered as a service, which is deemed to be the service as per the GST Act, that has not been challenged yet because it is exempted. So the transfer of going concern is exempted. But what if the transfer is not as a going concern? Then probably it will be treated as a service and be charged to service tax in the residuary category at the rate of 18%. But for the time being, let us try to understand as to what is the meaning of the going concern. Going concern is not defined in the GST Act. It has a meaning in the accounting standard, which many of you must be knowing since many of the participants are chartered accountants. But let us try to understand as to how the going concern has been defined in various judgments in the erstwhile regime in the various contexts. Honorable Bombay High Court, in one of the case, which is there in this particular slide, you can, this particular UC PPT will be mailed to you. But if you wish to note down the citations as we are discussing, you may also note down in your diary. So this particular Bombay High Court judgment says that if the business is to be characterized as a going concern, then it must be a live business. That means it must be a business which is running. It must not be a business which has been shut down. And it should be possible to undertake transactions once the hand changes. So one of the criteria which was seen was there must be stock in trade. If there is a stock in trade, then it is a very good indication to determine whether it is a going concern or not. So one of the tests in this particular judgment was laid down that if it has a stock in trade and it is a live business, and even if there is the transactions are not regular, but the transactions are taking place from time to time, it may not be going very smoothly. But if the transactions are taking place, then it can be presumed that it is a going concern. And it was held that whether a business is a going concern or not is a matter which is a question of fact. Now, another High Court judgment of Delhi said that it is to determine whether a firm is a going concern. It should be necessary to find out whether it is capable of being run independently for a foreseeable future. Further, whether the essential and integral assets like plant and machinery and manpower, without which it would not be possible to run an independent unit, should also be transferred to the demerged company. So if you take out the soul of a business, that is, say, main plant and machinery are not transferred, or the major manpower which are supposed to continue to run the business are also not transferred, then maybe a view can be taken that it is not a going concern. So one must determine these factors to satisfy the criteria. So while you formulate the going concern, these are the criteria which you must tick. You must, on the basis of these judgments, you may formulate your own checklist as to whether your going concern, whether what you are transferring is a going concern or not. And if it is not satisfying certain criteria, and if it involves huge amount of liability of GST, then probably you suitably modify the agreement for transfer or the scheme of the demerger, and then bring it in consonance with the criteria which has been laid down in the past by the various judgments. Now, Supreme Court, in one of the judgments, in the case of Allahabad Bank, it was held that in order to consider whether a company is sold as a going concern, it is necessary that along with the assets, the liabilities are also transferred. So suppose the necessary assets are transferred, but the liability is not transferred, then can we say that whether it is a going concern? The answer is no. But the another consequential question which arises immediately in the mind is whether it is necessary to transfer all the assets or liabilities, or whether if the key assets and liabilities are transferred, then it will be considered as a going concern. So Honorable Delhi High Court, in the context of an income tax dispute, it was held that just because certain assets and properties are left out because they would cause inconvenience or lead to some kind of trouble for the purchasing party, it cannot be said that it is not a going concern. And Honorable Karnataka High Court held that retention of certain liabilities while transferring the business by the transfer would not avoid the transaction to be categorized as sale of business transaction. So the sum and substance, in a summary, on a review of all the judgments, my opinion is that the key assets and liabilities, the manpower, everything should be transferred. The stock and trade should be transferred. And it should be possible to run the business which was being run in the past in the same manner or almost the same manner. It may be possible that there are some, obsolete machineries which the intending buyer don't want to buy. So they can be left out. The plant can be modernized by the intending buyer. Some of the liabilities which can be the cause of pain for the buyer, they may also be left out. But if suppose the whole of liabilities is left out, or the major plant and machinery, everything is left out, or suppose the whole of the plant and machinery is a junk, then probably it cannot be said that it is transfer of a going concern. And one must be very careful to take the benefit of this exemption. So one should very carefully weigh all the facts and circumstances of a particular case before arriving at a conclusion whether a particular transaction is a transaction as a going concern, or not. But at the same time, one can also take the benefit of how the business itself has been interpreted. And if the business, it satisfies the transfer of the business, and as we have seen in the context of various judgments, that it cannot be considered as a goods at all, then the question may arise as to, even if suppose it is not a going concern, then whether it is at all transfer of a business can be considered as a service or not. I believe we will get the answer in the future, as and when such a dispute arises and it reaches the doorstep of a high court or a Supreme Court. For the time being, we must, if we are doing a transaction, we should treat it as a supply of service, as a matter of abundant precaution, and then try to satisfy the definition of the going concern. The criteria of the going concern, we must draw our checklist and then structure our transaction accordingly. Yes, another issue, another couple of issues which are contextual to this particular discussion is whether, suppose there is a lump sum transaction, as we know, which is called slum sale in the context of Income Tax Act. But suppose the values are assigned merely for the purpose of accounting or convenience, then the question arises whether it will not satisfy the definition of transfer of a going concern or transfer of a business. So here there is a judgment of the Honorable Bombay High Court, which said that just because there is an assignment of value for the purpose of execution of conveyance of movable property, it would not debar it being treated as a slum sale. Further, one of the Madras High Court judgment said that if a person is carrying on business through different branches, units, or division which are separately identifiable from each other, then transfer of such unit, branch, or division having separately identifiable assets, liabilities, income, and expenditure would be considered as transfer of business as a going concern. Now, another issue, I think, which is very important in the context of GST is to understand the meaning of the actionable claim. Now, in the GST era, the actionable claim, other than lottery, betting, or gambling, are treated as neither supply of goods or services as per Schedule 3 of the CGST Act. Now, the question arises as to what is an actionable claim. As per the dictionary meaning, actionable means something for which action will lie in the future. So, in order to recover something, an action may have to be taken to make a claim or to assert your right to a claim, which may be in a unsecured date. So secured date is out of this definition of actionable claim. That is number one. Then it should be a beneficial interest in a movable property. And lastly, it should not be in possession. So something which is not in possession and for which an actionable claim lies to recover it in future is an actionable claim. So benefit of it is that if it is an actionable claim, then it is outside the purview of the GST. So Honorable Supreme Court, in the context of Sunrise Associates, versus Government of Delhi elaborated on some of the examples of the actionable claim. It said that negotiable instruments, the right to recover insurance money in the event of any loss, a partner's right to sue on account of dissolved partnership, right to claim the benefit of a contract not coupled with any liability, a claim for arrears of rent, and the claim for credit in a provident fund account are all examples of a actionable claim. So if anybody transferred these kind of a rights, say right to recover insurance money in the event of a loss, or partners transfer it right to sue on account of dissolved partnership, or right to claim arrears of rent in the future, or right to credit in a provident fund account, then these are all actionable claims and they are not liable to GST. And in a very recent judgment, Honorable Bombay High Court held that the amount pooled in escrow account for operating on online fantasy game constitutes an actionable claim, as the same are to be distributed among the winning participants. Now let us go to the definition of the term supply. The definition of supply is very wide, and it says that all forms of supply of goods or service, such as sale, transfer, barter, exchange, license, rental, lease, or disposal, made or agreed to be made for a consideration by a person in the course or furtherance of business is a supply. So one of the very important criteria that the transaction should be in the course or furtherance of business. So what is in the course or furtherance of business? We'll discuss in a minute. But for the time being, let us try to understand the very fundamental, or I think the most important term in this context of supply, that is what is a sale. Now, sale is not defined here in this GST Act, but in the common law, the Sale of Goods Act, the Constitution, it says that the essence of it is that it should be a transaction of sale or an agreement to sale which involves transfer of passing of the title in those goods. So there must be a transfer of title in the goods. That is the most important criteria to satisfy the definition of a sale. Mere contract of sale is not a sale for the purpose of levy of CST. It was held in one of the Supreme Court judgment. Because it was held that the agreement to sale creates no interest on the property. So what is essential is that the interest and property must be transferred for a transaction to be considered as a sale. Now, one of the contextual issues which arises is that what happens to the dealer supplying the spares during the warranty period? Because one of the criteria is consideration. Now, there is no consideration received for spares supplied by the dealer during the warranty period. But the dealer does receive a credit note from the original manufacturer. So it was held by the Honorable Supreme Court in one of the matter that the dealer which is providing spares free of cost to the customers during warranty period, they receive consideration from the manufacturer, and therefore It is a transaction which is a taxable transaction. Now, another important word in the definition of supply is transfer. So what is the meaning of transfer and why it is so used? The transfer is, you see, comparatively much more wide in its implication and meaning compared to the word sale. So the transfer may be voluntary or involuntary. If suppose the government acquires some property which is not voluntary, then in one of the Supreme Court judgment, it has been held to be covered within the meaning of the word transfer. So compulsory sale is also a sale because it will be covered within the meaning of the definition of the word transfer. Even though it may not satisfy the definition of the word sale, because sale, there must be a voluntary contract. So the question arises, what happens to an involuntary contract, a compulsory acquisition? They will satisfy the definition of the term transfer. And transfer may also include within its purview gift or exchange, as per one of the Supreme Court judgment. But for a transfer, there must be two parties. There must be a hand from which it is transferred to another hand. So there must be an existence of two parties in a transaction of a transfer. Now, another terminology which is used in the definition of supply is disposal. Now, the disposal also means transfer of title of goods to any other person. So if you just throw it away as a matter of disposal, then you may be required to reverse the ITC in such a scenario, but it is not a disposal which will satisfy the definition as incorporated in the definition of the supply. And even in a transaction of exchange, it must involve transfer of property by one person to another and reciprocally the transfer of property by that other person to the first person. So there must be a mutual transfer of ownership of one thing for ownership of the another. If that is missing, then it will not satisfy the definition of the exchange, which is intended to be included in the definition of the term supply. So again, if we go back and look at the meaning of the definition of the term supply, it says sale, transfer, barter, exchange, disposal. Lease, license, rental, I will cover separately. But all these sale, transfer, barter, exchange, or disposal, in my opinion, it must entail a transfer of property from one person to another person. Now, in one of the very interesting issue which I would like to discuss is the free supply to the contractors. We know that in many cases, big corporates or say government contracts, public works department ECC, they enter into a contract with the contractor to undertake a work which includes supply of goods. But sometime in order to have a control over the quality of the supply of the material, it is supplied by the principal, that is the contractee. So in such a case, the question arises whether such a free and that value of the supply at the time of passing of the invoice of the contractor, it is deducted. The value of that material which is supplied by the principal or the contractee is deducted. So suppose 100 rupees of contract is entered into, out of which say 40 rupees of material is to be supplied. And the contractor raises an invoice for the material value as well as the contract, the labor part. then the value of material which is supplied free of cost by the principal to the contractor, that is deducted. And it may be exigible to tax under the GST if the absolute property in the goods is transferred to the contractor and price is adjusted against dues to the contractor. Now, whether or not the property in the goods is transferred to the contractor, we'll have to determine it in the context of the facts of a case, and we'll have to look from contract to contract. But there are judgments which says that in such a scenario, it will be liable to GST. It will be liable to tax. Sorry. Now, another very important concept, I think, which we must discuss is what is the meaning of the term business. Because as we have seen, the definition of supply says that all forms of supply of goods or services, such as sale, transfer, barter, exchange, license, lease, rental, or disposal, made or agreed to be made for a consideration by a person in the course or furtherance of business, is only what satisfies the definition of supply. So there must be a transaction of sale, transfer, barter, exchange, lease, rental, etc. in the course or furtherance of business. So therefore, it is very essential for us to understand what is the meaning of the term business. Now, the business is defined in section 2, subsection 17. It is an inclusive definition. I will just refer to the first 3 parts because the other part of the definition are very specific to specific scenarios. I'm going to discuss the definition which is common to a trade, commerce, or profession. So the first part says, that is A says, 217 clause A says, that any trade, commerce, manufacture, profession, vocation, adventure, wager, or any other similar activity, whether or not it is for a pecuniary benefit, will satisfy the definition of the term business. Now, next, it says that any activity or transaction in connection or incidental to above is also business. Now, thirdly, it says that any activity or transaction in the nature of A above. A above means it must satisfy the criteria of trade, commerce, manufacture, profession, vocation, adventure, wager, or any other similar activity. If it does so, then the volume, frequency, continuity, or regularity of some such transaction is immaterial. So, in the context of this particular these 3 definitions, let us look at various judgments which have been rendered in the context of earlier era. Now, Honorable Supreme Court in one of the matter said that the distinctive purpose and objective of education would make it very difficult to assimilate it to the position of any trade, business, or calling or service within the meaning of section 2J of the Industrial Disputes Act. In a very recent judgment of the Honorable Supreme Court, which has been just delivered on this 7th November 2022, the dispute was with respect to the raising of the tuition fees. Again, Honorable Supreme Court has said that the education is not business to earn profit, and the tuition fees should always be affordable. So the sum and substance, in my opinion, is that if an entity is purely in the field of the education, then it is not satisfying the criteria. First criteria, it says that is any trade, commerce, manufacture, profession, vocation, or adventure, and it will not fall within the purview of GST. Now, what is the meaning of any activity or transaction in connection or incidental or ancillary to trade, commerce, or manufacture. That is what is the how the courts have interpreted part B of the definition. So interestingly, in one of the judgment of the Honorable Supreme Court, in the context of Sales Tax Act, where the analogous definition of the business existed, it was held by the Honorable Supreme Court that the activity of publishing and selling literature books and other literature is incidental or ancillary to the main activity of spreading message of Sai Baba and not to do any business. And if the main activity is not business, then the transaction incidental or subsidiary to it also not amount to business unless the main intention was to carry on the business. So while you see any activity which is incidental to business is taxable, but if some activity is not business, then any incidental activity to a non-business activity also cannot be termed as a business activity, even if it generates some revenue or it satisfies the definition of sale. So in this particular case, even though this particular charitable institution, where the main object of the establishment of this trust was spreading the message of the Sai Baba, and it was selling or publishing the books or the literatures or the other things, it was held that it is incidental to the main activity, which is non-business, and therefore such sale cannot be brought within the purview of the taxability of sales tax. In another Supreme Court judgment, which was relating to the activity of a port trust, it was held that the port trust is not carrying on the business of buying, selling, supply, or distribution of the goods. Carrying on business requires something more than merely selling or buying etc. And therefore, if the main activity is not business, the sale made in connection or incidental to the main activity would not be business. So this judgment is also in line with that Sai publication fund judgment. In one of the judgment, which was with respect to IIT versus state of UP, it was held that IIT is not a dealer as its principal activity is academic and not commercial. Then in another judgment, Institute of Chartered Accountant of India was held that it was the dominant activity is to regulate the profession of chartered accountancy, and therefore it cannot be termed as a business, and it cannot be involved in carrying on a business, trade, or commerce. In one other judgment of a university, it was held that the sale of publication by university is not business, as university is not a dealer. But unfortunately, in a very recent judgment of the Honorable Gujarat High Court, in the context of GST, it has been held that the charitable organization running medical store and selling medicines on no profit basis is liable to pay GST. But in my opinion, this particular judgment did not refer to the jurisprudence in the erstwhile era, and therefore I believe it is not a correct judgment and it should not be relied upon to determine whether a trust or an institution, whether its incidental activities can be brought within the purview of GST or not. Now, let us look at the other aspect of the meaning of incidental to business, that there may be some activity by a business entity which is not regular in nature and which is not its business, whether it can be termed as a incidental to carrying on business or not. So here there are some judgments which says that, for example, sale of escape material and advertisement material at cost price or even less than cost price is incidental to business. Sales at the store, in factory, is incidental to business. It was held that the sale by the state and transport undertaking of its unserviceable or old and obsolete part is sale of business. Sale of old machinery and scrap is held to be incidental to business. So it is very important to distinguish as to whether activity is incidental to business. If it is incidental to business, it will be liable to tax. But if the main activity itself is not business or not satisfying the definition of the business, then the incidental activities will also or cannot be chargeable to GST. Now let us look at the meaning of the works contract and how it is taxed in the GST era. First of all, let us a little bit go back in the history and try to understand the genesis or the birth of the concept of the works property. In a very old judgment of Gannon, Dunkley and others versus sales tax authorities, State of Madras versus Gannon, Dunkley and Company, it was held that the composite contract cannot be vivisected, and if it is resulting into immovable property, it cannot be exigible to sales tax. In order to overcome this particular judgment, the 46th amendment to the Constitution was inserted, whereby clause 29A of the Article 366 was inserted to deem certain transaction as works contract. And clause B of 29A deemed works contract to be transfer of property in the goods in a composite contract to be liable to sales tax. So the classic meaning of the works contract is that if there is a composite contract whereby one is rendering the supply of goods as well as supplying some services, then it is a works contract. And even if it is a composite contract wherein one is charging in a composite manner for the supply of goods or services, still the portion of it which entails the supply of material can be levied to sales tax. Now, in the context of goods and services tax, this works contract, I feel that the relevance is only to determine whether it is a supply of goods or service. Because now it is immaterial whether it can be taxed to sales tax or service tax, but because both the goods and service tax are covered within the meaning of GST. But still, to determine the rate of tax, we need to bifurcate whether it is a goods or service. Now, Schedule 2 of the GST Act is for that purpose only. It treats a transaction either as a goods or service because it helps us to determine the rate of the tax. Because unless the rate of tax is determined, we cannot pay the tax. And the rate of tax for goods and services are separate. They are notified by separate notification, because still today we have not reached a stage where the goods or service has the same rate across the board. Once we reach that stage where the rate of tax is uniform in the GST Act, probably this definition of works contract will become redundant. But till the time the rate of tax on supply of goods and the supply of services is different, it is essential to determine whether a contract is a works contract. Now, first of all, the composite contract or works contract. So the question which arises immediately is whether we can enter into two separate contracts. Suppose I am rendering service of installation of a machinery which is going to result into a plant. Suppose one has got a contract of installation and commissioning of a steel plant, where one is supposed to supply the goods part, the iron, steel, the cement and everything, as well as ensure the installation of the plant. Now, the question is whether one can enter into a separate contract for installation and separate contracts for supply of material involved, like supply of steel, cement, and other materials involved in such a contract. Now, this particular issue, you see, if we look at some of the advanced ruling, and this particular, you see, issue becomes very relevant, particularly if the rate of tax is more than 18, if the rate of tax is more than 18% or less than 18% on the supply of goods. Because on the works contract, by and large, the rate of tax will be 18%. So if suppose you are supplying the machinery which attracts 28%, for example, air conditioner, or suppose you are supplying the materials of the plant which is less than 18%, for example, solar equipments, which may be 5% or 12%, then it becomes extremely crucial to know whether it is possible for you to enter into two separate contracts. Now, there are two advanced ruling authorities judgments, which says that if you are entering into a contract for, one of the ruling is of AAR West Bengal, wherein it was held that the contract for manufacture, supply, erection and commissioning of transmission towers is works contract. It cannot be split into contract of supply of material, transportation, insurance and supply of surplus. Here the applicant was trying to split the contract to claim the exemption from goods transport charges. Similar ruling has been made by Authority for Advanced Ruling Maharashtra also. Now let us go back to the past and see whether we have any jurisprudence to help us to bifurcate the contracts if it is advantageous to us. Now, Honorable Supreme Court in the case of Cone Elevator Limited, it was held that if there are two contracts, namely the purchase of components of lift from the dealer, it would be a contract for sale. And if it is a separate contract is entered for installation, that will be a contract for supply of labor. But a pregnant one, once there is a composite contract for supply of installation, then only it has to be treated as works contract and not otherwise. So as per the ratio which comes out from this judgment of Honorable Supreme Court, it is very much possible to enter into two separate contracts, one for supply, one for installation. Now, in a very recent judgment of the Honorable Supreme Court, in Indian Hume Pipe Company Limited, the contract for laying of pipeline was divided into two parts. Now, here the reverse happened. Here the assessing authority wanted to treat it as a divisible contract because they had entered into or assigned values for two separate contracts. It was beneficial for the SAC to have it treated as a works contract because the rate was better, rate of tax was better. So they wanted to treat it as a works contract. But since they had entered into two different contracts for laying down the pipeline, Honorable Supreme Court upheld the view of the assessing authority which treated it as a divisible contract. It was held that it is possible to enter into two separate contracts for supply and installation. And if it is done so, then they will be treated as a separate contract and not as an indivisible contract. Only the indivisible contract, composite contract, which is not separated by the parties themselves, they can only be treated as a works contract. Now another, you see, departure, which I would like to discuss in the context of GST, is that if you read section 219 of the GST Act, it defines works contract as contract for building, construction, fabrication, completion, erection, installation, fitting out, improvement, modification, repair, maintenance, renovation, alteration, or commissioning of any immovable property. So please understand that in the context of GST, the definition of works contract is satisfied only if it is a contract, that is a composite contract, is entered into for the purpose of immovable property. So if it is a works contract relating to movable property, it does not satisfy the definition of works contract. So there is no problem at all. Then it will go to the composite supply, and then you can look into what is the dominant supply, and then according to the rate applicable to the dominant supply, it can be taxed. So as far as the composite contract which are entered into for movable goods, you will have to go to the definition of composite contract. Composite contract says that if you look into what is the dominant supply, and the rate which is applicable to the dominant supply is what will make the whole transaction chargeable to tax. But if it is a composite contract relating to immovable property, then it goes to works contract. Now, once it goes to works contract, then it is deemed to be a supply of service as per paragraph 6A of the schedule 2 of the GST. Then the question of determination of rate comes into the picture. And if the rate of contract is 18%, then you try to see whether it is beneficial for you to enter into two separate contracts, or whether it is beneficial to you for enter into a composite contract. For example, if it is a contract for, say, air conditioning, then obviously it will be beneficial for you to enter into a composite contract, because such a composite contract will entail levy of tax of only 18%. Whereas if you enter into separate contracts, then probably the supply of air conditioning will be applicable to 28%, and the labor part or installation part will be applicable to 18%. But suppose if it is a contract for the installation of a solar plant, then probably it will be better to enter into two separate contracts, where the rate of tax on solar plant is, supply of the solar plant is less. Earlier it was 5%. Presently, I think it is 12%. So accordingly, depending on the situation, you can take a call and enter into a contract. Now, within this context, it will be very essential to understand that if a plant or machinery is assembled and erected at site, then it cannot be treated as a goods, provided it is not marketable and movable. So if it is installed in such a manner that is embedded in the earth, then it does not satisfy the definition of the goods, and then it will go and satisfy the definition of works contract, and therefore the rate of tax accordingly will be applicable. So even in the context of a installation of a plant and machinery, one has to be very careful to determine whether the plant and machinery which you are installing, whether it is possible to detach it easily, dismantle it, and remove it to another place. If that is the so, then it is a movable property and it cannot be considered to be a works contract. But if it is attached to the earth permanently or embedded to the earth permanently, then it becomes immovable property, it becomes works contract, and accordingly the rate of tax will apply. Now the another issue which I feel is very important to discuss is, or where there is going to be lots of disputes, is agreeing to refrain from or tolerate an act or to do an act, which is covered in entry 5E of the Schedule 2. In the erstwhile era, it was taxable as a declared service by Section 66 E, capital E of the Finance Act. Now let us look at the various judgments in the erstwhile era of the service tax regime as to some of the transactions which have been considered either to be a declared service as tolerating an act or refraining from an act or otherwise. Now, in one of the judgments of the Honorable Calcutta Tribunal, amount collected for encashment of bank guarantee was not considered to be tolerating an act, and therefore it was not considered to be declared service. Surrendering of tenancy right was also not considered to be an obligation to refrain or tolerate an act, and therefore it was also not considered to be a taxable service. Compensation provided to the coal miners due to cancellation of contract also was held to be not qualifying as service to agree to tolerate an act. Then amount recovered as compensation owing to damages, owing to delay and breach of contract also was considered to be not as a toleration of an act, and therefore not liable to service tax. The foreclosure of loans was considered to be a compensation for possible loss of interest revenue, and it was held that the foreclosure premium is a kind of compensation for the possible loss of interest revenue on the loan amount returned by the customer. Therefore, it was also not considered to be liable to service tax. Now, the forfeiture of amount received by the hotel from a customer on cancellation of booking is also considered not to be liable to service tax. Then settlement of termination for development agreement for various landowners is not considered to be declared service. I think the issue which is most common, and a lot of litigations are still pending in the service tax era, is the liquidated damage. Liquidated damage are in the nature of compensation, where the other party, one of the parties, is penalized for breach of terms of the contract. For example, if there is a stipulation as to the delivery period or the quality of the product or any such terms, and if either party violates the terms of the contract, then the other party is liable to pay liquidated damage or penalty to the other party. So the question is whether such a penalty or the liquidated damage for breach of the terms of the contract is liable to GST. The department frequently considered it as agreeing to obligate to refrain from act or to tolerate an act. But there are number of tribunal judgments which has been held that the purpose of imposition of such a contract or compensation is to ensure that the defaulting act is not undertaken, and the party intentionally does not tolerate such an act. Such clauses are not for tolerating an act, rather such clauses for ensuring that such acts are not done at all. So it is honored. It is a kind of a compensation or damage for breaching the terms and not for toleration of an act. Therefore, they are not liable to service tax. In another very interesting judgment, the SSC collected theft charges for unauthorized usage of electricity, and it was contended by the department that it was tolerating an act of unauthorized electricity uses, but it was held that nobody intentionally tolerates the theft of a electricity, and therefore it is not liable for service tax. Now another interesting couple of judgments in this context which I would like to discuss is there are a number of tribunal judgments which says that the notice period recovery. For example, if you must be knowing that there is a contract between employer and employee, that if either party does not give the necessary notice, for example, for an employer to remove an employee, it is necessary to give 2 months notice, or it is necessary for an employee also simultaneously to give 2 months notice to quit his job. And if either party violates, then 2 months salary or a predetermined amount is paid by the other party to the other party. So if suppose the employer recovers the amount from his employee for not complying with the notice period, then such a recovery is not liable to tax as it is part of the employee salary. Now, another very interesting judgment which has come in the context of the GST era itself, that is a Bombay High Court judgment, that the payment of royalty as compensation for unauthorized occupation of premises is not a supply, as it is enforcement of a violation of a legal right is not a consideration for supply. In the absence of a reciprocal enforceable obligation, it is incorrect to characterize the penalty of royalty as damages to be treated as a supply for consideration on which GST is payable. Another issue which last few issues only I am going to discuss, so kindly bear with me for another 10-15 minutes, then I will take up the questions and close the session. I know I am interfering with your holiday and you must be looking out to go with your family for some activity. So I will try to close it as soon as possible. Another issue which I would like to discuss is the transfer of development rights. Now, one may argue that transfer of development rights, by entering into transfer of development right, the question is whether one is permanently or irrevocably transferring his right in the land, and whether it is as good as the sale of land. We know that the sale of land is outside the purview of GST by virtue of entry number 5 of the Schedule 3 to the CST Act. So the one may argue that whether the transfer of development right, when the landowner enters into a contract with the intending buyer, with the developer, then whether such a right, whether at all it is a service, because the GST Act presumes it to be a service. So the question arises whether at all such a transfer of development right can be considered to be a service or not. Because if it is not a service, then irrespective of the tariff notifications and all that, whereas presently the developer is liable to pay tax on the reverse charge mechanism on the development right in case of an unsold stock of the residential property, and development right in case of a commercial property is liable to tax under the reverse charge mechanism by the developer. So the good question, I think the legal question which arises in my mind is whether the development right can be considered to be a sale of land, and therefore whether at all it can be levied to GST. So there is a authority for advance ruling couple of judgments which has come out. It has said that the levy of tax is not on land, but the levy of tax is on the benefit arising out of land. So in this context, I would like to discuss whether the benefit arising out of land, whether it can be considered to be within the purview of the definition of land itself. Now, the land is not defined in the law, but the benefit arising out of land is considered to be within the expression of the meaning of the land in several acts. For example, Land Acquisition Act, the Bombay Land Revenue Code Act, and the General Clauses Act. The immovable property definition or the definition of land includes the benefit or the arising out of land. And in the Bombay High Court, in the context of Cheda Housing Development Corporation versus Bibi Jan Sheikh Farid, had held that the transfer of development right being a benefit arising out of land must be held to be an immovable property. And there is a tribunal judgment also in the context of service tax, wherein it was held that the transfer of development right is not a service. It was held that when the landowner transfers land development rights to the developer gets the right to not only develop the project, but also the right to sell such developed property along with the undivided interest in the land underneath. And therefore, once the landowning company transferred the land development right to the developer for a consideration, it is obligated to transfer the undivided interest in the land in favor of the developer's buyer, for which no separate consideration is paid. So therefore, it is nothing but the transfer of ownership of land, and the development right or transfer of the development right cannot be considered to be a service and therefore liable to tax. So I think this particular issue is going to be decided in the near future. It is pending before the Honorable Supreme Court, and let us see where it goes. Now, here I would like to just point out that since this matter is pending before the Honorable Supreme Court, so if any party is aggrieved, then I would advise that if you are seriously aggrieved, then either you should join as an intervener in this particular matter, which is already pending before the Supreme Court, or you may also decide to file a writ petition under Article 32 directly before the Honorable Supreme Court and get your matter tagged with this particular matter, which is already pending before the Honorable Supreme Court. Now, one of the advice or the opinion which I would like to give in such matters of joint development agreement to avoid any kind of a taxation, even within the present purview of how the government intends to tax it, by entering into some sort of a revenue sharing or profit sharing model, which is referred to as joint venture. Now, joint venture is defined in one of the judgments of the Honorable Supreme Court, which was in the context of the Service Tax Act, wherein it was held that it is to be distinguished from an independent contractor, whereby one party does the act for the other. In a joint venture, it is an association of persons to engage or carry out a venture for profit motive by combining their knowledge, their skill, their money, their property, without creating a formal partnership or without creating a special purpose vehicle or corporation or a partnership firm or any entity. So, in my opinion, many of the problem of taxation can be avoided by structuring your agreement carefully in such a manner that it satisfies the criteria of a joint venture. Now, for what is a joint venture, you will have to see that from the terms of contract, it does not appear that one is acting under the control of the other or direction of the other. They are independent. They are merely bringing together their knowledge, their resources, their property, and their money to make a profit. Now that profit may be divided either in form of the constructed property, or they may choose to share the profit arising out of the venture. The manner of profit is not determinative of whether a venture is a joint venture or not, but it is the intent which matters. So one can always structure a agreement in such a manner that it satisfies the criteria of a joint venture. And if that is done so, then it will be outside the purview, then that the transfer of development right can be kept out of the purview of the liability of GST on part of the developer, also under reverse charge mechanism. Now, another issue, I think, which is very frequently litigated is long-term lease. Suppose one enters into a 999 years lease, and upfront some salami or premium or by any other name, whatever name, by the local practice it is called, or pagdi, or whatever it is called, that lump sum money is taken at the outset, and some very nominal rent is only taken, then the question arises whether it is a sale of permanent sale of land, or whether it can be treated as taxable. Now, this matter also, one of the tribunal judgments where it was held that the premium which is received at the outset is nothing but a rent received in advance, therefore it is liable to service tax, is pending before the Honorable Supreme Court. In this case also, if one chooses, one can either become an intervener or also file directly a writ petition under Article 32 and get your matter tagged with the matter which is pending if you are the affected party and you wish to be heard. You have a point of view which you feel that you want to bring it to the knowledge of the Honorable Supreme Court. Now, in this context, I would like to point out two judgments. One judgment which has been rendered, which is also pending before the Honorable Supreme Court, was Builder Association versus Union of India. Here, the long-term lease was considered to be liable to GST, and a one-time premium which was paid was considered to be nothing but a measure of on which tax is to be levied, and therefore it was liable to be taxed. But interestingly, in one of the judgments, it is which is in the context of the not in the context of the service tax. It was held that a long-term lease of 90 years is not an agreement to lease, but an agreement to sale. This judgment was in the context of RERA. Here, the facts was that the 80% of the cost was paid, and the substantial amount of the stamp duty and registration charges were also paid, and the lease rent was nominal of ₹1 per year. And it was a lease of long-term 999 years. So it was termed to be nothing but an agreement to lease. The nomenclature was not considered to be important. The essence was considered to be important. It was held that it is not an agreement to lease, but an agreement to sell. Now, the last topic which I would like to discuss is the transaction between related party and the distinct person as defined in Schedule 1, where even if there is no consideration, but if there is a transaction or supply of goods or services between distinct person as defined in Section 25, meaning thereby that if there is a transaction between, say, head office and branch, or factory and branch, factory and head office, if there is a supply of goods between such entities, then since they are considered to be separate person and liable to be separately registered under Section 25, So they are considered to be distinct person, and if any transactions takes place between them, then they are liable to GST even if there is no consideration. And I've just referred to, I usually avoid referring to any authority for advance ruling judgments, but I've referred to some of the ruling here because I am totally in agreement with such ruling, which says that if suppose any activity is performed by employees at corporate office or branch office or head office, then it should be treated as a supply. And in one of the ruling, it says that it should be chargeable or valued at 110% of the cost. So I think one must be very cautious in these aspects and pay the tax because it will be admissible as ITC to the other unit. And there is no necessity to unnecessarily enter into any sort of a litigation. With this, I conclude my talk. Now I would take up some of the questions. Now, one of the query is whether the sale of repossessed assets by a bank can be treated as a sale of going concern. Whether the bank sale of industrial factory land leased to a borrower by a government can be treated as sale of land and exempt from GST. I don't think so, because the repossession of the assets by a bank, it is not usually as a going concern, and therefore I don't think it can be exempt from tax as a going concern at least. Now, whether transfer of business, see, I'm trying to answer those queries which are relevant to today's topic, because there are queries which are not relevant to the today's topic. So first I will try to answer queries relating to today's topic. One of the queries, whether the transfer of business from registration to another registration of same pen can be exempt under transfer of business. Now, for a transaction to take place, transfer to take place, there must be two entities. So I don't think there can be a transfer of business from one registration to another. Mr. Mane has queried that one of my client has received so-called notice regarding filing of appeal under GST after completion of time period. Date of order is 19. Appeal filed on, as per judgment, excluded time is up to 28 to 2022. But the officer is the reason for delay. What should I do? You see, if you have filed appeal after the limitation period, then I think the only saving grace can be if you can find out if there is a violation of natural justice in the order in original. There is a judgment of the Honorable Madras Court which says that if there is a violation of the natural justice in the original order in original, then the limitation failed for filing of the appeal can be ignored and the order in original itself can be quashed. In transfer of going concern and solemnity, one can avail ITC in professional provided for such. Yes, I think so. You can certainly avail the credit. Recovery of business loss from employee will attract GST or not, as employee made some loss of assets at client side. I think I will have to look into the query in detail. What I would advise is that you can text your queries to me in detail. I have just shared my email ID. You can ask the program organizers also to share my email ID with you. And if you can send me your queries in detail, then I will try to individually answer all your queries. As of now, I've shared the email ID already. So, friends, thank you very much.
Thank you very much, sir. It's
Can you share my email ID? Because I am not able to share it with all the participants.
I'll do that.
Is
I'll do
going to hosts and panelists from the.
Okay.
So if you can, yeah, thank you. So if anybody has any query, they can mail it to me. Thank you very much, Mr. Abdullah, for sparing your time on this.
It's my pleasure, sir. I think today's session participant seems to be comparatively low. I think we can
Yes.
make up next session, and we will be sending recordings to all the registrants who have already registered with us
Yeah.
tomorrow. And I think we'll announce next session's date in very soon.
Yes, yes, sure.
If you have any date on your mind, we can announce it today itself.
No, we can do it fortnightly as we have decided.
Yeah.
Let us now not skip the dates. So we'll keep it on 8th of January.
Yeah, that is perfectly fine. We can do that.
So if we can immediately announce and then we repeat the announcement across social media and other, you see, so then people will know, because I think this time we were a little late in announcement. And
All right.
earlier people were waiting for it, and then for 2 weeks it did not happen.
All
So
right.
I believe I will have more participants and people will benefit more.
We'll announce in all social media by tomorrow itself.
Yeah, thank you. And kindly just mail, I will just now mail my PPT also.
Yeah.
So share the PPT along with the link of the YouTube session so that people